Good evening, everybody. It doesn't look quite like evening, but I guess it's early evening here with the late afternoon sun and summer holidays. So, my name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms. And I am back to talk about our stock market strategy using closed-end funds. To get the normal disclaimers out of the way, this is an unedited video. Who knows what you'll hear in the background as I film these in my house. My cat is currently out and about and hunting something. Don't quite know what. I am not a financial advisor. I'm a strategist and a financial strategist, and I don't speak like the herd. I walk in very limited company, and sometimes I walk alone. So, for everybody, whether you're new to my channel or you've been here a while, thank you for being involved. Thank you for commenting. Thank you for sharing the content. And as you can hear in the background, my family is on the move, in and out. Uh, the more comments on the videos, the more that tells the YouTube algorithm to push the videos out and share it with more people. The more you comment, the more you like the videos, the more you subscribe, the same thing is true. So if you have questions, ask. If you have comments, add them. If you have feedback, give me the feedback and be honest. Don't be trashy uh, just to be trashy. But if you have poignant, relative, on on task feedback, by all means, give me some feedback. If you have information that you want that I'm not offering, let me know what that is. I'm always looking for ways to improve my content and improve what I'm showing by video. Um, I did go through today and this week and look back through the overall strategy guide, I guess you could say, for closed-end funds. And I, I'm a I'm a perfectionist at heart. I like getting stuff right. I don't like making mistakes. And I like when everything's in order. I'm in the process of writing an ebook about our financial strategy. And yeah, all the stuff in the background is the hazard you run when you do live video and raw video for that matter. So um, I've been writing this ebook or just writing this book on our overall 12 steps to financial freedom. And one chapter, the longest chapter there is entirely devoted to closed-end funds and the system and the structure uh, behind this video and every other video. So as I'm going through and editing that chapter, really the book as a whole, it's so I can make a video on the content, but the content's not ready because I'm in the process of moving locations. Uh, I'm currently housed on Facebook, but I have not liked their setup. So I've been looking for another place to host and house my content outside of these YouTube videos here on Facebook, or excuse me, outside of these videos here on YouTube. There you go. Um, but looking for a hosting platform for the day-to-day comment, along with different parts of the system, and I think I've found it. So my goal is really to launch that new place. So if I could build the system and build the info and get that up and running, then the references I use in the book actually have a real existence. And then I can finish off the content in the book and then share that because I have had, there we go, several people ask about either an overall strategy guide. I've had people ask about the spreadsheets, the kind of a how to set up a spreadsheet or dividend sheet, et cetera, as well as just a like a shareable monthly update to the closed end fund master, where instead of just getting my highlights off the video, you would have a place where you could access the entire closed end fund master, download it, and sift it for your own reasons. Um, so yeah, it's very much a work in progress, but I think I'm finally starting to make some actual progress on that. Um, So as I look at the market for the week, I went back and gosh, everybody sends out emails on Sunday. I wish they sent out emails on Saturday, but and there are groups that send out emails on Saturday, but the bulk of my reading ends up happening on Sunday. But one of the comments I made on the video last week and previous weeks was that this the HGLB fund, the Highland Global Allocation Fund, was somewhat of a mystery in the sense that they used to be very direct. Like they invested in four or five things and that was it. And between what I could see on CEF Connect and Morningstar, they had since diversified, and it was kind of off-putting. But I finally tracked down the HGLB fund and found their recent semi-annual report, which is 4 months old. Um, they're not as diversified as it sounds. So when I share my screen, you'll see several other tabs up more than normal, um, and they'll relate to the funds for this week. But HGLB is not as diversified as it seems. But I guess I'm getting ahead of myself. So uh, as I look back at the week, my goal is to make this short. And I know when I've said that in the past, it hasn't always been short. My goal is to make it short this week. So if we look back at the last week, the review of things and the current reading of the tea leaves, President Trump and Secretary Treasury, there we go, Treasury Secretary Scott Bessent are making a public display of replacing Jerome Powell as Federal Reserve Chair because Powell has pursued power over purpose. His purpose, his job is to respond to the data, not insist on creating the narrative. The Fed likes to be at the forefront of the spotlight when the truth is they should be in the shadows, which they have been. But they should be behind the scenes reading the data and being committed to their double mandate of both controlling, however you want to say that, controlling rates and reading the data, or reading the data and controlling rates. Uh, so this is not a debate of whether you think the Fed should exist or not. And if you've watched my videos, you'll know that I'm opposed to the Fed. I think we should go back to a gold standard or a silver standard of currency instead of everyone's perceived value of monetary worth. But if you believe the Fed has a reason to exist, the Fed is supposed to get data, interpret the data, and it's all inflation related interest rate data, right? So they should get data, interpret the data, respond to the data, and control interest rates based on the data. So if inflation is running rampant, they jack rates. If inflation is low, they lower rates, right? That's how it should work. The Fed is not supposed to control rates based on the chairs or based on the governance board's perceived fears or on the chair's desire to leverage higher rates to increase his power. Powell has not done his job, and I can't wait for him to leave. I mean, I would, if he's going to play ball and lower rates, then great. But right now, he is sitting on high rates, all based on his fears, which is what he's telling people. He just likes power, and the Federal Reserve likes power. They don't like being um, manipulated to do things, but that's really the war we're facing right now, or the struggle we're facing right now. But we need lower rates. I mean, yes, the economy is chugging along despite the Federal Reserve induced inflation fears, but the American populace needs lower rates. So why needs? Right? So from my standpoint, we need lower rates. But if the economy is chugging along, why do we need a lower rate? Because the data dictates policy, not a person's feelings. The facts point to lower inflation data. That means the Fed should be cutting rates based on the facts, based on the data, and the facts say they should cut rates, but they're not. The core inflation data is down, and the Fed should have decreased rates 5 months ago. Why the delay? Well, supposedly the Fed and Jerome Powell are scared that tariffs might increase inflation. But like we've talked about for at least the last 6 months, tariffs don't increase inflation. Studies have shown that tariffs have zero impact on inflation. You know what tariffs do, right? They get people to the table so we can negotiate better deals. And it's fine and dandy when other countries do it, but well, I won't say everybody, certain people in the US kind of flip their lid when the United States imposes tariffs because, well, that's more political than I really want to get to. That's a giant rabbit hole. We'll just say that there are people inside the US who are opposed to tariffs, not based on monetary policy or anything else. They just don't want the US to succeed. So tariffs, in essence, decrease our out of pocket expenses, and that drives inflation down. Now, Powell's not afraid of tariffs. He's afraid of losing the narrative war. But at this point, he's not only lost the narrative war, he's proven we're doing just fine without him. And that's not meaning that we should just keep interest rates high. Like, despite interest rates, despite Powell, despite all the fear the Fed is pushing, the economy is chugging along. So, yes, we're doing just fine without him doing his job. But at the same time, we need him or someone else who will do that job. Because if the Fed really dropped rates and cut rates, the economy would break open. And by clinging to power, Powell has rendered himself powerless. It's like I it's like I have to be here no, you actually don't. I mean, you've been there and done nothing, and the economy is powering along, mostly because the Fed's not printing money, or at least not printing money as openly as they were. Right? So if we don't need Powell, why do we need the Fed? But if Powell's not going to do the job, we need somebody who will do that job. And base inflation rates or base interest rates on accurate inflation. Now, that being said, I still think inflation sits at least at 3 to 4% a year. So when the Fed says inflation's finally down to our 2% metric, I still think inflation sits at 3 to 4%. It's always higher than they say. So if they came out and said, oh my gosh, inflation's at zero, the value of a dollar is actually worth a dollar, I would still say inflation's higher. I mean, they're gonna color it with, I think the saying is they're gonna color it with rose tinted glasses. They're gonna make it as best as possible. Right? Like it's like covering a cake with fondant. You smooth out all the dimples and make it flat and flush. So I still think inflation is higher than what they let on, but at the same time, inflation is lower than it has been, and they're not cutting the rates. And that's the issue. So if the Fed won't cut the rates, then please, by all means, put somebody in there who will do the job as it needs to be done and not based on feelings. Now, if Powell plays ball, he'll stay in power. And if he refuses, he'll go the way of the dodo, and he will be remembered for being the dodo, the guy who was always behind the curve and always holding the economy hostage. So just with that information, it makes the selection process this week pretty easy. I mean, you can advocate for almost anything at this point. I mean, especially following that initial tariff dip. I mean, the history of tariff dips, if you look back and you see the dip, I mean, almost anything for the next year does exceptionally well because it dipped and you bought it near the bottom, and it's just going to come back and respond. If there's a secondary tariff dip, when the next round takes place, which I believe is around August 1st, then that's another amazing opportunity to buy. Right? So why even do the video? Like if everything's amazing, why even do the video? Because there's still stuff out there that's better than the rest. Right? I mean, you could argue for anything. But really, we're back to the same old song and dance. We're at the forefront of the next golden technological revolution, and anything tech is great to a degree. I mean, I'm not buying single stocks. Uh, I'm looking for really like solid blue chip dividend paying closed end funds that can weather any economy, whether it's this the next golden age or whether it's not. But that said, everything, at least everything tech, is more expensive than it was a month ago. But it's also cheaper buying now than buying a month from now. So you can kind of spin that ball however you want. And if you're buying tech, I don't fault you. If you're buying blue chips and US stock investments, I don't fault you. Fueling all of that tech is oil because everything tech is a derivative of oil. Without oil, you don't get the golden age of technology. So the drill baby drill standard is coming back, and we're at the forefront of that. We haven't seen the full effect of, I won't say excessive, but we have not seen the full effect of a lot of oil being on the market. Gas has come down despite all the world panic. Gas has come down, but it's not down where it won't say it's not down enough, but it's not down to where we want it to be. 250 in Texas, or at least in my area, is pretty decent. We really want it. I mean, 225, $2. My daughter asked me how things were back when I grew up. And I was like, I can remember when premium gasoline cost 99 cents plus gas tax. But I mean, I don't think we're going to see that far of a downward shift, but we should see a continued decreasing amount in gas because there's more of it. And when there's more of it, it makes technology easier to produce because there's more of it. And it also makes technology easier to transport because there's more gas or more oil, however you want to say it. So me, I'd play it differently. I can advocate for tech. And the two funds that we have that are tech focused, I mean, we really have, you can argue that every fund in its own way is tech focused with the advance of technology and AI. Um, the two funds that are really three funds, four funds, depending on how you look at it. NBXG and ADX are blue chip based, single stock, uh, technology, AI growth forward. With that is NML and KYN. NML is energy, utilities, energy transfer, oil, and KYN is mostly master limited partnerships and energy transfer. And the four of those together make a great combination. Thing is, oil in and of itself is not a great deal right now as it relates to a discount. And for us, the NML fund and the KYN fund are both well above board, well above our buy-in average. They're just not a good deal right now for us. ADX and NBXG have both increased in value, and they're good buys in the long-term sense, but they're not exactly the best buys in this market. They're great buys, but they're not the best buys. So me, I'd pay it differently, or at least I'd play it differently. With rate cuts on the horizon, I'd buy bonds and bond proxies, right? And everything will do better with lower short-term rates. But of the potential outcomes, bonds and bond proxies have the most potential for the best outcomes. Higher rates, like right now, mean lower bond prices. I still get paid a fat dividend. And they're cheaper bond prices, so the herd looks away from that. They see it as a bad thing. I see it as an opportunity. Cheaper bond prices, fat dividend is easy money, especially when they are significantly discounted. But lower rates mean higher bond prices, and the dividend should continue, right? So now I've gone from wide discount, like if you think of a window being open, window shut, no discount, window open, wide discount. So I've gone from wide discount, cheap bond prices, fat dividend, to a closing discount, which means the net asset value and the share price should go up, and I still keep getting a fat dividend. So if we're buying tomorrow and we're not, because we just bought, I think, 2 weeks ago, right? So if we're buying tomorrow and we're about 1 to 2 weeks, I guess we're 1 to 2 weeks away from us buying, pending on that. Like if there's a lot of fear and panic leading into that next round of tariffs, then we might sit back and wait for that day to take effect and then buy after. And if there's that much pushed panic before it happens, you know how the herd goes, right? I can hope that the herd learned from the last time, but history says they haven't. So if there's a ton of fear and panic leading into Tariff 2.0, then I would buy that dip. Um, but if we're buying now, I would be dumpster diving the bond and bond proxy basket looking for prizes because I am hopeful. I am expectantly hopeful and looking forward to the increasing potential of lower short term rates, meaning the Fed would cut rates. And if and when that happens, I expect the herd to arrive late and to overstay, meaning we've already bought low, we bought the wide discount, we get the fat dividend, and the herd will come in and they will buy more shares. So they will help increase our prices because there's less shares available. They'll help increase value because it's more attractable. So that discount window will close and we're still getting paid the dividends, right? And I want the herd to pile in. So if that happens, we get presented with a new question. Do we stay out? Or sorry, do we stay and keep collecting the dividend and watching our money grow? Or do we cash out and push the money forward elsewhere? And you should think about that now so you're not tempted by money and overstaying later. See, we're still using the present to buy the best thing for the long term. We're using the present to scoop deals with the long term game plan in mind. And it comes down to strategy. Are you a buy and hold investor, meaning you're going to buy it and then just hold it indefinitely, lifetime, never going to sell it, it just sits? You'll add to it maybe in dollar cost average. You'll add to it based on discount, or maybe you'll just add to it whenever you feel like it, right? Are you a swing trader? You'll buy something and then at a set price point or price range, maybe say 20% threshold. So you buy something and with a 20% increase, whenever that happens, by either dividend percentage or growth percentage, or a combination of the two. So you buy it and then 20% later you sell it. Really doesn't matter what price point it is or how much further it's projected to go. As soon as it hits 20%, you sell it and you push your money forward into the next thing. Or are you kind of a mix of the two? Are you meaning are you a hybrid where you're a buy and hold on some and you're a swing trader on others? And that swing trader value, I mean, it's really up to you. It could be 30%, 40%, or at a specific price point. So as for me, I'm a mix. And you can see that reflected in our portfolio. I have uh, every fund has some sort of label, whether that be lifetime or life, long-term LT. Uh, some have some are listed at a specific sell point, like sell at this price point. And it's just a reminder of what happens when that happens. Like it, knowing that going into it, it's easier to make that decision. So if you know the strategy and are ready to implement it, you'll be less tempted by greed. Now you will still be tempted by greed. You're going to be tempted by, oh, I should just stay in and last it out. And you're going to get tempted by greed. You have to set the parameters to tell yourself when to get out. And then when you get out, you move on, right? You pull the money out, and have fun with it, pull the money out, do whatever you want with it. Or on our end of things, we'll sell things and then push the money forward and reinvest it somewhere else. So let's get into yeah, let's get into the week, and then we can kind of keep talking about different stuff. So this is the breakout of the closed-end fund master for this week. I mean, I went through the spreadsheet like normal. Um, Everything color coded got an update on cost and net asset value. I went through the targets, and I have this list. And I'll be honest, when I have a bigger screen available, I will deep dive and do a true update of everything. But on my, gosh, it's a bugaboo on this little laptop to see numbers at like 65%, 65%, and have four different screens up. It's challenging. Uh, I'll get a bigger screen and get do more like the month to month data doesn't change that much in the grand scheme of things when it comes to say like a historic discount or a 5 year discount. But it does change a little bit based on the fund like DSL uh, or MEGI if we're tracking yearly discounts. I mean, 1 week can do a lot depending on how the week goes. But so I'll do a more complete system update in about a month or two. But currently, this is the update, and it's the breakout for the week. Uh, and if you're familiar with this, you'll notice a fund that's different. This is a new fund, and I wasn't specifically looking for this fund, but it was noticeable because it occurred. And when I go through things alphabetically, it sits right above this company, and I noticed it. I went, you know what? I know the Hersfield name. I'll go back and look, and sure enough, Cuba, CUBA, not the country. Cuba used to exist, that it was run by Hersfeld. Cuba doesn't exist anymore, and this took its place. And it's been around for about a month. And I get that it pays a giant yield, but not all funds, not all dividends are equal. We bought Cuba uh, probably 3 years ago, and we sold it. The guy who runs this company kind of helps. It sounds like he was involved in the initial forays of closed-end funds. He came highly recommended. But Cuba at one point sold all of their stocks and went to cash, and were paying their dividends for they pay quarterly, but they're paying their like years worth of dividends just in cash. And I checked this one out, and Morningstar isn't always accurate, as I'll say here in a little bit. But currently, I mean, it's a brand new fund, but all of their assets are in cash. Um, so it's notable, but it's also just not going to make the list. Uh, all right, so if we do the initial sort, so we're looking for monthly payers. So this one drops off. That being said, the Gabelli funds, uh, Gabelli is a well-known closed-end fund um, leader, director, however you want to say that. I mean, his funds are well known, and he's a well known guy. He seems to lead his funds and manage them exceptionally well. This I don't think this fund has been this deeply discounted in a while. Um, but it's just not going to make the list. Um, so that leaves us with all monthly pairs. So next we want to sort by yield. I like reverse. The metric has been 9% or above, unless there's a good reason to keep it on the list. So that's a municipal fund, but we already have three. SABA used to be mostly government bonds, but now it's still just derivatives and a hodgepodge of bonds. Um, NBXG is all stocks, all tech, all 5G tech based. Um, Consistent dividend, but yes, higher than it has been. These are municipal bonds. Calamos has attracted my eye for a while. I just can't, I don't know, there's more consumer stuff than I would like. I'm not a huge overtly consumer staple by consumerism. It's not me. So I like the fund. I just haven't bought it. Calamos Allspring, we owned a different fund of theirs. Not a fan. Yeah, and the ERH, I mean it utility wise. So yes, their cost is improved. They pay a decent yield. Discount is still wide open. But they honestly pay a variable dividend. It's not consistent. I don't like that. I like consistency in my dividend program so I know what I get every month. I don't like the variable dividends where I don't really know what I'm going to get. Eaton Vance, if you made me pick between Calamos and Eaton Vance, and they were both, so if they had significant discounts, if they met the price point, if they met the dividend point, I would still think I still think I'd pick Eaton Vance just because they sell calls on their funds, so they generate a little more income, and I mean, it juices the dividend. Excuse me, it juices the dividend, I guess you could say. Um, but when it came down to it, I looked at Calamos, Eaton Vance, and ADX, the fund we ended up buying, and I chose ADX based on company history, longevity, overall growth. Um, the dividend is quarterly, and I love monthly payers. Quarterlies are not my favorite, but even if I broke out their quarterly payment into a monthly system, it still had a higher dividend than both of these, and Calamos. Um, and Calamos, there were maybe it was like 600 different investments inside a fund, and that gives you a lot of access. That also insanely diversifies your portfolio in a can. And then Eaton Vance was like 300 to 400 ish, and it's the same idea. I mean, it's targeted investments, but it's very portfolio in a can. Versus ADX was less than 100 in 4 or 5 sectors, very targeted, not diversified within sector, but at the same time not diversified into everything. So I like the focus of their portfolio. And even though it's not monthly, and even though it's above my general comfort level of price point, I bought ADX. And it doesn't make the list this week because it doesn't meet the discount metric. Eaton Vance does not. All right, HFRO is the real estate fund from Highland, and they hit the dividend point because the share prices dropped. I mean, almost every real estate group dropped this week. I don't exactly understand. The municipals don't make it on surface value, but their tax equivalent dividend generally sits 2 to 2.5% above what the posted dividend is. DLY's bonds, we own the sister fund in DSL. DLY, their spread has not been this wide in a while. So it on their end of things, it's a great deal. For us, we own the sister fund. Buying the other one, unless it was a completely different structure, buying the other one is just redundant. ZTR makes it on a dollar cost average. We bought it on that roller coaster play. Uh, Lower interest rates would help this fund out. I mean, it would help every fund out. Lower interest rates would help this fund out. And quite honestly, it's earmarked for sale. Whenever it hits a specific price point, we're selling it. CIF, another roller coaster buy, has a specific price point. Meggy makes the list. I mean, it's pretty much exactly where it needs to be considered. It is a bond proxy on our end of things. And so I'm going to say this and then counter this. It's higher than our current average share price. That said, in a long-term setting, you're going to buy funds that are both above and below your average price. And I mean, the whim would be that you're always buying below your price, but at the same point, then your fund's not growing. So it is above our average price. Say it's like dollar 50 above. Yeah, it's a dollar 50 above our average price, um, which is not undoable. It's just it's going to cost you more. But as a term, specifically now, it's a term fund unless the board changes that. But as a term fund, when it hits at or when the discount is at or greater than the existing discount, excuse me, when the current discount is at or eclipses the average 1 year discount, then it's a great time to buy. DSO makes it on a dollar cost average, but it's not going to stay. FCO will stay for now. EIC, I looked at for closed end fund, or not closed end, collateralized loan obligations, but we own a fund that's currently like, I mean, EIC is maybe 3 times more expensive than OXLC, so it doesn't really give us anything different. So why would I pay 3 times as much as what I could get it already? PIMCO, we would be buying the brand name. And yes, based on, of the three exceptions to the triple asterisk rule, I mean, there's DNP, which doesn't meet the metric this week, ADX, which doesn't meet the metric this week, PDO, which is finally at a better price than 4% over. I mean, 3%, that's different. But on our end of things, it doesn't give us anything more than what we already have. Like we would be buying it for brand name and brand affiliation, not necessarily what's in the portfolio. So it doesn't really improve us. It just diversifies our portfolio more. And I'm generally against the diversification of things simply for the diversification of things. BRW, I've hit on a lot. Well-run fund that's very pro shareholder. And I typically tend to buy these in tandem. Um, FCO is a giant US only based bond fund that is also a private lender or the business development company, um, which works great in the existing economy. BRW is it's, I hate there's got to be a better word for diversified, or maybe a better application of the word diversified. BRW used to be into bonds and other closed-end funds. They've expanded into crypto, minerals, and metals. And with the advance of the crypto market, I like that there's a well-run closed-end fund that also invest in crypto. I, I want to say there are a couple specific crypto-based closed-end funds, but I don't know near enough about crypto that I need to, and I don't know how well the funds are run, but I do know BRW is well run, so I'm comfortable with them taking that on for me. HGLB I've talked about a lot in weeks past, and I'll get to that. And OXLC I've got more to say this week too. So HGLB, I've looked into this. This is what Morningstar has, which is more information than what CEF Connect has. And if we look at how they break out the portfolio in and of itself, I have suspected that the terminology might be the same, but its application is different between investment platforms. On my end of things, I don't like the idea of defensive, sensitive, and cyclical. It's too general, and people throw the terms out expecting you to know what they mean, and they could apply them however they want. Um, I'm not a consumer staples based person, and I mean I don't have a better system of terminology. I just wish there was a better system of terminology. So I finally deep dove HGLB. I looked beyond what I could see surface value, and I tracked down their portfolio. And in looking at their portfolio, look, communication services are listed as its own thing, but that's all technology, especially when you look at what midwave wireless does. And I used Grok. I wish that service bar would go away. I used Grok to get all that data because Google was a little wishy-washy on what midwave wireless was doing. Maybe not wishy-washy in the sense of they were like hiding it, but they didn't really explain it. Versus Grok explains things. And if you wanted more information than what was here, you could say, explain it to me in language a high school kid would understand. And Grok will do the same thing. So midwave wireless is pretty like it's insane how much bandwidth and um, just midpoint on the spectrum, how much coverage they have inside the U.S. Um, and it really is just a growing market space, and it has a ton of potential. And it sounds like Highland is a early investor and owns a lot of. I don't think I cannot say if they own a majority share in the company, but when midwave wireless is 25-ish% of your portfolio and you own $73 million worth of it, I would say you're a definitive contributing aspect of their portfolio. Um, so what scares a lot of people with technology investments, like if we pulled up ADX or NBXG or even the Eaton brothers, the you'll see a higher weighted percentage on technology because that's the current golden boy inside our stock market, to where um, the big, like Nvidia, Apple, Microsoft, Alphabet, Meta, ASML, IBM, Tesla, you'll see all of those companies almost heavy weighted, like 5% plus, to where the big 10 or the big 15 almost have like a 30 to 40% dominance inside that portfolio. And I mean, I like targeted investments. I like people who know what they're doing, know what they're investing in, and they're unafraid of what's in the other categories. That being said, it caught my eye how much of this portfolio is based on the value of midwave wireless. It can really skew the value of the portfolio. I mean, really skew the value of the portfolio. And I don't want to be wishy-washy about it. I love targeted investments. I hate diversity for diversity's sake. It just seems like a big chunk of the portfolio. I also noticed on Highland, so that we'll say like 25-ish, 26-ish% in midwave wireless. There we go. They've also got a beefy real estate portfolio, like 20% here. There's, I want to say 3% somewhere. So like 25-ish% of real estate. That's great for the current market. But a lot of it is in their own sister fund stuff. Like Next Point Managers manages Highland, they manage HFRO. So they're invested there. They're also invested in HFRO over here. So it's a lot of self-investment. Um, I like that they're invested into energy and utilities. So I get that they're listed as a portfolio in a can, but it's less portfolio in a can than it looks like on surface. It's also more targeted than what it looks like on the surface, even more targeted than what they list here. So I'm not going to rule it out, but I will go about it cautiously. So I can delete those two tabs and three tabs. The other tab I want to show you is an article off Seeking Alpha for the week. Seeking Alpha made more of their content free, which I like. Now, I don't necessarily align with Seeking Alpha because we're going about it in different means with different hope for outcomes. But I do like this guy's take on OXLC. And instead of me just reading what he wrote, I'm just going to show you what he wrote. And if you like the content and want more of it, then by all means, go check out Seeking Alpha. So what I'm going for is the highlighted part. So you can pause the screen, right? What I'm going for specifically is down here. The CLO boys, like the CLO fronts, it's really, and there's been a lot of, I won't say bubble, but like there's been a lot of sporadic, spotty behavior in the CLO front because of these fears of defaults. But the default rates are actually pretty low. And it comes down to if you think people will be able to pay back what they owe. Like will borrowers be able to make the payments? And that's where the short-term interest rate stuff comes back. Because if rates go down, then that decreases. So my credit, I won't say mine, we have a credit card rate, which unbelievably is at like 11.5%. That overall rate is low, but it's also based on that short-term Fed rate. So if the Fed rate goes down, then auto loans go down and credit card fees go down and interest rates go down. And that already 11.5% rate will go down. So if short-term rates go down, then borrowers will be better placed, right, or better situated to pay back what they owe. So in the next 5 years, or even the next 3 to 4 years, if rates go down now, then the next 3 to 5 years seem to be, or it seemed to put OXLC and their counterparts in a really good situation. With with low interest rates, people will be better able to pay back the loan, so default rates should go down. And default rates are also pretty low as it is. So, and I'm with this guy, although for very different reasons. This factors into what I'm thinking, but just based on the surface value, share price sits between 4 and 5. They've cut their dividend. It used to be higher. They cut it in half. It used to be this. So, yeah, and it's still a crazy dividend. It seems that way, but they're still able to cover it, right? But this is the big thing, the discount. For whatever reason, the discount has opened up. And that's the fear angle. I don't There's a ton of fear in the CLO market space based on defaults and debt and payback. And in the midst of our economy where everything is just chugging along stubbornly, in the midst of crazy high interest rates, I don't understand the scare unless some of these companies took on more than they realized. I mean, if you made yourself a bad deal, then yeah, you're going to get burned on it. But that's not an OXLC. So the advice generally is when it's in discount, it's worth a buy. Like it's worth a nod. But that discount doesn't stick. Like it might be like a 0.5% or 1%, but currently it's close to 6%. That's worth a look. So this is the list. I mean, but could I trim it down further? Like if the focus is bonds and bond proxies, then yes, all of this fits. But if I'm really going to hyper focus, I'm really going to look for the best prize in the dumpster fire, or the best prize at the bottom of the dumpster. If I'm really going to section that stuff out and get a great yield, but if I'm really going to scrounge through the discounts to pick the best thing, then I would eliminate these two. And if you notice prices, that's the most expensive one. You can argue it's a utility, it's an outright utility. Um, it's a solid play based on the numbers. We can leave it on the fringe, right? But if I'm playing the discount, then I'm buying real estate, technology, CLOs, and municipal funds and or municipal bonds, however you want to say that, right? And if you want to leave in the utility fund, then we can leave in the utility fund. But that's the list for the week. And if we're going to deep dive the discount, we're going to focus on the best possible set of funds that puts us in the best possible position for what I still am I really am. I'm hopefully expectant we will see lower rates by the end of the year. I didn't think we were going to cut in July because people are still on vacation. I mean, if you want the spotlight, and remember the Fed wants the spotlight, they want to be at the front of that narrative. So if they want the front of the spotlight, or if they want the spotlight, they want to be at the front of things, then they will cut in August or September where it puts them back in front of everybody. People are back from vacations, kids are back in school, adults are back to being focused on work and finances. Some people are somewhat looking forward to the end of the year, or people are looking towards Halloween and Thanksgiving and Christmas and how they're spending money. And you would hope the Fed would do this in April or May before everybody moved over the cyclical summer, right, for school and jobs and et cetera. But they didn't. So now on the back end of summer, with the end of the year approaching, the most people possible will be paying attention to what the Fed is doing in August and September. So if you think like an egomaniacal narcissist where everything's about me and I get all the spotlight, and when things are amazing, I go, hey, look at me, that's the Fed. And doing things in the summer when a lot of people are out of pocket doesn't give them the most screen time and video likes as they want. So if they're going to cut, which current projection, there are people now like I don't think we'll see a rate cut by the end of the year. And if you see that version of Powell, then I think he's out of a job. Um, but if the Fed cuts rates in August and September, that gives them the most screen time, makes them look insanely great, like insanely good. Um, Powell will keep his job for at least another year. And now everybody's happy. So we'll see how that goes. But in lieu of that, if we if we maintain the high interest rates, that still doesn't change the yes, I'm hopeful for lower rates, and all of these are well placed to do better with lower rates. But even considering higher rates, all of these are still well timed, well picked, uh, like great buys now and higher rates. So yeah, I'm sticking with this. These are my picks for the week. If you want an even smaller list, you want an even smaller list, you could take Maggie away. Or like if we were investing in a Roth, it's so our Roth is tax-free income so long as you jump through the hoops. That doesn't really make sense to invest in other forms of tax-free income. So if we were doing this in a Roth, then I would eliminate the municipal bonds and just focus on the top four. So that's honestly all I have for the week. And I could browbeat this and go in circles for a while, but I'm not. Uh, Not my style to lengthen out the video just to lengthen out the video. And I don't want to waste your time. So if you like my content, please consider subscribing to my channel and then help me get the word out to YouTube. Help me get the word out to people that there is a better way to invest than the traditional stock market strategy where you buy and hope stuff goes up in value. We are, uh, and the goal is to maintain our principal and grow it. The goal is to supplement or live off dividends. regardless of what the market does. And you really can, gosh, you really can thrive on a dividend based portfolio as opposed to buy, hope, and invest with no dividends possible. So help me get the word out to people that there's a better way to invest now and in the long term. There's a better way to invest for retirement. And then interact with me, like videos, leave me a comment, uh, talk about the funds you own, or ask about funds I own, and then share the video and like the video, and help me hack YouTube. So if you want to find me day to day, leave me a comment here, and whenever there's an update on my end about uh, what I hope to be my new hosting platform, then I will update you on a video. So I wish you a great week. Yeah, I wish you a great week, and I've got a lot of work to do. I don't know about you, but I have a lot of work. I have a lot of work to do this week, and I'm tired and stuttering a little bit. So, uh, yeah, I will call it there. So I wish you a great week. I wish you success of whatever you're doing this week, and wherever you are in your financial journey, I hope you make progress. So, see you on another video. Have a great week, everybody. Bye bye.